Hey everyone, it's time for a Kenny's clip. Just wanted to give you an update after last week with everything going on. We've got a real problem here. Stocks are continuing to decline. There is a substantial risk of a major worldwide dislocation due to the war. The risks of the Strait of Hormuz, we still can't get it open. Iran is now charging ships that are they're letting through to China, and it is clearly an issue that we can't seem to fix. And the risks are the Houthis in Yemen just started firing at Israel, and if they shut off the other path through the Red Sea for oil, that's another 4 million barrels a day that are going to get stuck. That's 4 million barrels that are being piped across Saudi Arabia to avoid the Strait of Hormuz. If they're able to stop that gap, then we're going to be short 15 to 20 million. I mean, technically we're short 20 million, but some's getting rerouted through that other strait. So through the Red Sea. So that's a real risk. Australia is about 18 days of running out of diesel, and gas stations are already reporting and closing because of lack of fuel. Taiwan is about 17, 18 days away from running out of natural gas, and there's nothing on the way either. So that's the worst part about it, is that there's even once they do run out, there's nothing shortly coming to fix the problem. So Taiwan, why do we care? Well, they only make all the chips, all this AI building boom, blah blah blah. They're going to have to stop manufacturing here soon too. So anyway, the risks here are getting really substantial to our economy, to the stock market. It's causing dislocations in the real estate market because of the rise in interest rates, and because of the interest rates going up with a lack of demand for treasury bonds, that is making mortgage rates up to 6.6% late this week. So it's becoming a real issue, and it could get dramatically worse if the liquidation in the stocks starts feeding into consumer sentiment, which starts feeding into more selling of stocks, which starts feeding into more consumer sentiment, and the downward spiral goes. Just like in an upward spiral, things can go the other way. And with stocks as overvalued as they have been, this is what can be a real problem. When it comes to gold, gold has flattened out at about 4,500. It rallied on Friday, which might be the beginning of a new rally, or it could just be a slight correction in its correction. So it could be a counter trend rally that may reverse. If everything collapses, I can't imagine that gold's not going to start dropping again. But one never knows, since it is the new currency that the Chinese are trading oil with Iran and with Russia. They are using gold via yuan exchanges. So it is a medium exchange, but it is becoming a liquidation asset, since it's something that people need in a shortage of capital for buying overpriced oil at this point. So not to get into the politics of this, but this is really got the risk, if we don't just walk away, of becoming a real problem. If Trump escalates this with attacks on oil infrastructure or the energy facilities in Iran, that's just going to make things worse. Personally, I think we need to finish off whatever military assets we need to destroy and just get the hell out of there and run tail between our legs as soon as possible. But anyway, that's neither here nor there when it comes to the markets. And so we have this whole problem. Excuse me. We also have private equity, which I've been talking about. UBS, United Bank of Scotland, has had some talked about some big issues there, some issues in the European investments in private equity and private credit. This problem is spreading. It's spreading relatively fast because people want their money back. And so what's going to happen is this is going to be a slow train wreck, just because it already is. It's already been going on for 5 or 6 months. So it's not going to be quite as fast unless there's a real big fund that goes belly up. As a result, funds are cutting their asset values down 10, 20, 30%. They've gated it so people can't take their money out. So that's driving more people to try to get their money out of other equity, private equity or private credit funds. So it's becoming a run on the bank, and that can have a life of its own. So that is tightening up the banks, which I talked about in our last Kenny's clip. That is adding to the liquidity crunch that the world is having. This oil crash or this oil surge and this war is causing a crash in liquidity, and that liquidity crunch is being worsened by the private equity issue. So we're not just talking one factor here. We've got the war, we've got the private equity issue, we've got banks tightening credit, we have housing getting weak and weaker, prices getting weaker throughout many parts of the United States, and that will continue. And the housing market could slow down with interest rates at 6.6%. The latest new home sales have been really bad, 9.7 months of houses on the market in new homes, and that market is slowing. And I guess I would not be surprised if that's not a precursor to the existing homes. I don't think our number of sales are going to drop terribly, but the prices that people are going to get, which is going to affect consumer sentiment. And once again, that whole consumer sentiment factor that oil price is high, stock market's dropping, 401ks balance is dropping, et cetera. So that all can feed into itself. The Fed needs to do an emergency cut here in the next week or two if the Strait of Hormuz is not opened right away. They will unlikely do that, but if things really start falling off the wheels start falling off the bus, hopefully they will not be political and will start cutting interest rates. Sounds crazy, cutting interest rates with inflation going up, but this is a supply shock, and it will be short-lived, as a recession will be forthcoming if oil prices remain too high for too long, as the other effects that it has on the economy, not just oil. Oil is not, it's not going to destroy the economy with inflation, et cetera. It's not as big of a part of our economy as it used to be, say, in the 70s and whatnot. But the sentiment is the problem. And that sentiment with stocks, private equity, the other sentiment going wrong in stocks is AI. AI is starting to eat up software stocks. It's eating up all different kinds of companies. People are worrying about it. And then Google just this week on Friday, I think it was Thursday or Friday, comes out with a new system that will take 6 times as less energy or 6 times as less chips. So what does that mean? NVIDIA's in trouble. And some of the other manufacturers are going to need to manufacture a lot less. So it is an interesting, technological advances are so fast right now, and that's great, but and that's going to increase productivity, but it's not going to help the potential downdraft in the stock market, which we've been seeing this week. So another item, so we got the housing, we got the Fed that might be stuck in a rock at a hard place. We've got stock prices, we've got bonds going the wrong way. So we really have a lot of different issues there. So also, I just want to mention the 60-40 portfolio of having stocks and bonds. Don't do that. That is a dangerous thing. That type of systematic investing, like the 2030 or the 2035 or the 2040 fund you may have in your 401k, that has a certain amount of investments in stocks and certain percentage in bonds. Bad idea. Bonds are in interest rates are on an uptrend. They were in a downtrend for 30, 40 years. That trend has been broken. And with the deglobalization, with the war, with everything, inflation, all that going on, bonds are not going to offset your losses in stocks. Just like in 2022, stocks crashed. And guess what? Bonds crashed. So there was no safe harbor. The only safe harbor may be commodities and precious metals like gold and silver. And even with liquidations, those may not be safe. So anyway, be careful out there. Bond allocations are dangerous unless you're just holding the bond till its maturity. So if you're buying a 1-year bond and you're going to get 4% on it and you're going to get the 4% at the end of the year, that's fine. But don't hold bond funds, which is what all these set retirement accounts in your 401ks have, is bond funds. And those funds are going to drop as interest rates continue to rise. Now, if we do have a crisis, we may eventually get a drop in interest rates, which would make bond funds perform better. But so far, that's not happening. A little bit of a sign on Friday, but we don't know if that's going to happen again down the road. So be careful with the 60-40 fund. Like I said on my last Kenny's clip, I'm out of stocks 100%, which I can't think ever having been out except for the 2008 time and 2007 when the real estate crunch was happening. This private equity problem is easily as big as of a banking problem. It just may not have to happen as fast because it's not public and it's not, the values aren't realized except every quarter. So it's unlike the mortgage market. So it's a little bit different, but so it may take longer on that part, but it could be accelerated by a downdraft in all these things that we've talked about. So be careful out there. Like I said, I don't have any stocks. I've got some gold, added a little gold at 4,400 or so last week, but really I'm real small on anything just because there's risks. Now, there's also the upside risk of a Trump says everything's good. They've killed all their military targets. They're pulling out. That would create a huge rally in stocks, and me being out would have been a waste. And I'm willing to take that risk in case the downside happens. Because if I lose 30, 40, 50% in my investments in my IRAs, that takes twice that to get back, right? So there is that risk that the markets could rip at any time that Trump chickens out, which I'm hoping he does any day soon. So anyway, be careful out there. I am definitely scared. It is a time to be fearful about what's going on. Be careful with your money and be good to your families. We'll take care. Thanks.